This is TreppWire Week in Review for week ending June 12th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with our own experts, Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, it's declared official. The longest economic expansion in U.S. history ended in February. We are in a recession. And the Fed offered some sobering projections. GDP will contract by 6.5% this year, and the unemployment rate is expected to end the year at 9.5%. You'll remember that it was just over 13% in May, a number that the Labor Department admitted was understated. All this prompted the central bank to hold the Fed funds rate and further signal that it will hold near zero until 2022. Wall Street didn't seem to welcome the Fed's outlook, and Chairman Powell's commentary in a press conference that said it's going to be a long road back. And a lot of the news we saw this week reminded us of that. Let's break it down.
Well, you know that for the last several weeks, I've been taking the bearish position, glass half empty. I thought the market had gotten ahead of itself quite a bit. We've seen or had seen an enormous run up in airline stocks, cruise lines. Some retailers got nice bumps, and it just seemed to really defy the reality on the ground. That being said, I almost changed my stripes this week. I went out on Monday, and I happen to live near a big open field, and there was a dad there hitting fungos to his boys and a couple of neighborhood kids. The only mask was a kid had a catcher's mask on. Nobody else had masks. It was a beautiful New York day, about 75 degrees. And for just an instant, I thought, I'm wrong. We're going to turn this around. We're going to bounce back hard. And I was the wrong guy. All these people had been piling into stocks. And it didn't last long, because then I went back and I watched the news, and it was kind of sobering, a lot of store closings and other things. And I just can't get away from the fact that if you believe that the U.S. economy is made up of 70% of consumer spending, if 10% of that consumer base is hit hard with layoffs and store closings and business closings and other things, it's hard to picture a scenario where we are firing on all cylinders, by January. Just hard to see.
Well, fungos, you brought me back there, Manus. I remember I used to have a fungo bat, and I would hit golf balls with it like 1,000 yards. It was a lot of fun. Well, I think, we had the jobs number come out this morning, or not the jobs number, but the unemployment claims number, which was, not as bad as it has been. The continuing claims actually dropped. I think it was 20.7 million or something, down a million, a little bit more, give or take. I'm going through a serious sleep reversion episode with my son right now. He's 18 months old. He's teething. He's waking up in the middle of the night. He's not going to sleep. He's whatever. And there's a parallel here. And maybe my not getting enough sleep is the only reason there is a parallel in my brain. But there's this concept of like, you put the kid to bed, he's sleeping. Oh man, we're going to go back to normal. We're going to get there. Here we are. It's 9 o'clock. He's going to sleep through the night. The economy is going to come back. Midnight comes around and bam, he's up. And you're like right back to square one, right? And that was like today in the market, today being Thursday, with everything down 6 or 7%, the airlines down, gambling stocks down, Carnival down, everything. And you think, damn, like we were almost out of it. And I feel like we're going to be having this fits and starts conversation for months to come. I do love all of the news and the memes and the social media coverage and the CNBC coverage of all of us dang millennials who got our stimulus checks and put them in a Robinhood account and bought Hertz and Brooks Brothers stocks and Carnival Cruise Lines and all this other stuff. And I can't believe that there's enough money there that's actually moving the markets, but it seems like there is. I hope not all of us get wiped out. I should say the royal us. I'm not really day trading, thank God. But I don't know. I think we will get back. I still believe in Warren Buffett. You know, the American tailwind still exists. We still have, the best workers in the world, the best innovation in the world, the best human capital and actual capital, financial capital. So it may be rough and it may take longer, but we will be back. The glass is more than half full, Manus.
The one thing I'll add to the fungo story is that if I had been 9 and there had been a shutdown and I was told that I couldn't play Little League, I think I would have gone out of my mind. My parents, forget about not sleeping here and there like you have with your 18-month-old. My parents would have never slept. The outrage would have been so enormous. I couldn't imagine being them. But I look back on those days fondly. I had the pleasure of playing with the King of Queens during my Little League days. That's right.
That's Kevin James for all you non-sitcom watchers.
Paul Blart Mallcarp.
Well, I was driving by one of those fields the other day where there's 4 or 5 fields, next to each other. And it was a Saturday. It was, May 30th or whatever it was. And I'm looking down there and it's empty. And I'm thinking, when I was a kid, that place was packed with opening day, hundreds of Little League games and all this other stuff. And it's I can't imagine. I mean, thank God for video games for those kids.
Only 2 guys had the great white cleats back then. Joe Namath and Paul Blart Mallcarp. Great white cleats.
Maybe we can get them on here to tell us about your Little League batting average.
I don't know. It's probably like my stock winning average. They're probably about similar.
We have about 11% of our listeners right now Googling fungos.
Fungos and Kevin James.
I felt good for you, though, Joe. Dunkin' is hiring 25,000 workers. A lot of them are returned to work, and I know you are a Dunkin' fan, so.
Well, Dunkin', Taco Bell, Domino's, Buffalo Wild Wings. I mean, Dunkin' Donuts holds a special place in my heart. There is a Dunkin' Donuts on Bronx River Road in Yonkers that I spent more time in during college and right after college than almost anywhere else, studying for the CFA, stopping in there every day to get a cold brew before going to class or whatever it was. I talked about it in one of our podcasts, but there was a group of crazies in there that hung out all day. If you wanted to know who was going to win in the 4th race at Yonkers Raceway, you asked the guy when you first walk in. If you wanted to know who killed JFK, you asked the crazy lady in the back. It was the perfect place for me, but it's really good to see that, type of rehiring. I'll be interested to see McDonald's, Chipotle, some of these other fast food places that were able to remain open during this quarantine. I haven't really been following their stocks or their earnings or anything, but I would think that they fared through this better than your average kind of restaurant, which had to close down.
Well, my son carried them by buying food through the drive-thru, so I know it's true.
Well, we've talked about, how it's all about food, underwear, and toilet paper, right? Or sanitizers, right? Not underwear. Food.
For you, it's about food, underwear, and toilet paper.
Well, I always want to wear underwear. I'm not a commando guy, but food, toilet paper, and soap, right? If you had those things, you came through this pretty well. But on the retail side, it's hard to remember a worse week in terms of the sheer number of bad headlines we saw. And it's kind of big and small, right? On the big side, we saw Simon walking away from their gig or their deal to buy Taubman's. Taubman's came back and said they're going to countersue to force the deal through. But obviously, when Simon came in, they bought with a 6.2% cap rate on these things. After COVID, who knows what that cap rate is, but, not a good sign for the shopping mall space. Kind of mid-market to down market in the clothing side, Brooks Brothers closing stores, several over the across the U.S. Men's Warehouse filing for bankruptcy. Right, we may have seen the end of the suit, right? For the foreseeable future. Who's going to need a suit anytime soon? Other places, Signet Jewelers, another 400 stores, their stock was off 16% on Tuesday. They've said in the past that they're going to move away from their reliance of mall stores, and that's they underscored that again this week. Zaro's also closing stores, rethinking their business model. So
Zaro, the pretzel place?
Not Zaro's, the pretzel place, and that's Barro's pizza place.
Zara,
the clothing place, the just-in-time inventory place.
Zara.
So just a lot of negative headlines there, and we've always talked about this as being death by 1,000 cuts, and this week it felt like we got 1,000 cuts in just 4 days.
Well, you're not going to be able to. There's a lot of hurt to the high schooler. You can't go get the necklace for the Sweet 16 at Signet. You can't go get your tux for prom, right? And you can't go to the mall because it's closed to hang out with your friends.
Well, the thing is, there is no Sweet 16 and there's no prom anymore anyway. So you're just kind of sitting down there with your joystick, playing NBA 2K or whatever people play these days.
Call of Duty.
When we talk about the soap, one bright spot that we talked about in TreppWire, I think Thursday morning, was that a property in Ohio that we had been watching, they had lost a food service tenant, a big swath of the space, 63%. The loan failed to pay off at its balloon maturity date. We had been watching that back to the 2014 deal. This week, Purell, or the maker of Purell, their corporate owner, came in and took a big swath of space, 400,000 square feet. So it looks like that mall, or I should say that industrial property, hopefully will now muddle through. So that was one thing, but it does come back to the food, hand sanitizer, and toilet paper. That's where you want to be.
We talk about remittance numbers for June. They're still coming in, so we're about a week away from getting an early indication where the delinquency and special servicing numbers will end up for that month. What should we be looking for?
Well, I think that it's hard to imagine things not getting materially worse in June than they were in May. And the reason we say that is we had 19% of hotel loans delinquent in May, but there was another 14% that didn't make their May payment, but were not yet delinquent. They were in that grace period. So even if only about half of those guys go delinquent in June, you're talking about a delinquency rate of 25 or 26% for hotels. Retail, 10% delinquent last month, but another 12 or 13% didn't make that May payment. So again, if half of those guys don't get forbearances and go delinquent, you're now talking mid-teens. Those, combined, those will make up, a big chunk of the CMBS market. And if you see any slippage in offices and multifamily, then the number could really surpass the all-time high. That's not out of the question.
We had Jan Niffen, who is a retail guru and CNBC contributor, on our podcast a couple weeks ago. And we saw this week that he made a prediction that about a third of the malls will be completely gone in 2 years. And that's an adjustment from a prediction that was around 2030. What are some of the problems, pivots, and ditching that owners are trying to muddle through, Joe?
Well, first of all, how long do I hold on for? Right. I think we talked about it in our interview with Tammy and David from the Henley Group, which we'll kind of tease a little bit in a few minutes. There's this, Manis talked about it like an option, right? So you're an owner of a mall. You have this, you're holding on until maturity of your loan in 2 or 3 years because you're still cash flow positive. And you're thinking at the end, maybe I can pull through, maybe I can pivot, maybe I can replace a JCPenney or a Sears with a Dick's Sporting Goods or somebody else, probably not likely because those guys like to be outside the mall. But if in 2 or 3 years I haven't figured it out, I can hand over the keys because I have a CMBS loan and it's non-recourse and I don't have to worry about, corporate default or anything like that. I really loved Tammy's line in our interview when she said that it's really there's no place for the middleman anymore, right? In terms of retail. So, someone's selling directly from the company to the consumer is still doing decently, right? Apple, look at Tesla, right? Things like that. Victoria's Secret's not a great example, but they've historically had very high, sales per square foot, those types of things, specialty retailers. But a JCPenney, a Macy's, a Neiman Marcus, buying things from distributors and then selling them to the consumer, I don't think there's a place for that anymore. Especially now that people have become more willing to buy, try on, and return. Right. So I feel like there's not a magic bullet, but there must be a series of slightly interesting bullets that somebody's going to come up with to replace the space in some of these malls with something that's productive. I don't know what that is. Is it co-working? Is it server farms? Is it, distribution center for Amazon? I really don't know, but some of them is a bulldoze, right? But there's something we haven't thought of yet, and there's too many smart people and too much money out there to not figure out a way to use this real estate.
I think it's mass sanitizing. You drive there and you get into a convertible, you come in one loading dock, you go right through the middle like a car wash, they zap you with ultraviolet rays, and when you come out, you're COVID free.
They stick a Cinnabon in your mouth and they take a picture of you with Santa and you're out.
That's right. Right down the middle of the inline stores, and you come out, come in the vacant Sears and you navigate through the JCPenney on the way out.
You're like Andy Dufresne, right? Came out clean on the other side.
That's right.
A Shawshank reference. I love that. Well, one of the things that we saw was Neiman Marcus in Hudson Yards is being marketed as office space. So that's one of the pivots, Joe, that I think you were talking about. And some of the factories and warehouses that are up for grabs, Amazon's looking at JCPenney's. And it'll be interesting to see who takes the Brooks Brothers factories that are in the southern states.
Yeah, I think that pivoting slightly for the moment, I think that as New York goes, the rest of the country goes. And I think that some listeners may say, well, that's a typical New Yorker's way of looking at things. You've looked at this that way for decades. All New Yorkers do, right? We're very self-centered. We look inward. We think our city is the greatest thing ever. But when you look at New York and you think of what it's been through for the last 3 months, it has 7 or 8 black marks against it at this point, right? It has over inventory on the office space. It has huge COVID numbers, right? The biggest in the country. Huge exposure to business travel, which, I don't think we're seeing business travel get above 25% for another 12 months. Huge impact there. Huge overseas travel, right? We did see that American Airlines was going to open up 55% of its flights domestically, but it's still going to be at 20% overseas, right? So you have that enormous impact from overseas flights. New York is a very big leisure destination for Times Square and Broadway, right? So you have just all of these strikes against it, and you have a very savvy workforce that has figured out how to work from home. So when you add that all up, and when you consider how places like New York, and if Boston is similar, or Washington, D.C., what the cumulative effect of that will be, the drag on those places, if those come back with huge unemployment numbers, huge negative GDP, and it lingers, I think, the U.S. economy has a lot of strikes against it, and it is something to watch. The positive for these cities is that they've had real demand from the big 5 or 6 tech guys, right? Facebook and Amazon and others, Google. But I'm not sure how far that takes you. I mean, they've taken up so much space over the last 5 years. How much more is there for them to give, number one? And number two is, do those firms start to say, considering, how hard they were hit with COVID, do we diversify a little bit more? Do we open in more space in Salt Lake City, Austin, Texas, Pittsburgh? So watch New York, watch Washington, San Francisco, and Los Angeles. How those places come back will have a lot to do with, how the markets look a year from now.
I'd, just kind of a little bit of a digression there. We looked at this article from Housing Wire that Manus, you pointed out to us about the surveys of, tenants coming up, multifamily tenants, and in the next 6 months, how many or what percentage of them are potentially going to renew, not renew, or unsure, right? And it was 30 something percent said that they're probably not going to renew.
Well, the numbers were scary. It was 26% definitely renew, 36% not renew, and 38% were likely
Unsure.
to maybe. But
so I'm thinking, is there a play here in the single family rental game? Now, I don't know. You have to have enough money to be able to move from an apartment to a house and rent the house, but there may be something there, right? I think single family rentals have been increasing ever since the last recession in terms of, Blackstone buying up swaths and swaths and building, American homes for rent. We see a little bit of it in the securitization space, but I'm just wondering about the migration flows that come out of this. And I think you said as New York goes, everywhere else goes. I think as New Yorkers go, that's going to tell us a lot, like where they go. I think we're all going to be watching Keegan to see how long he stays in Brooklyn versus, moving up to Maine or, Colorado or the woods of Saskatchewan or something like that.
So just going back to that survey, and I'll throw a few other numbers out there. 26% were yeses, we will renew. And this is for leases coming due in the next 6 months. I didn't add that. If you look at only tenants that had apartments that were costing more than $1,700 a month, so the upper end of the market, maybe not in New York, but the upper end of the market nationwide for sure, 18% of those people were hard yeses that they would keep their apartment over the next 6 months. And that is just a brutally low number. A few other things to throw out there. On CNBC today, new Manhattan leases, apartment leases down 62% last month. Empty apartments, the number of vacant apartments up 34%. And the number of brokers now offering a month and a half of free rent up to 42%. And of course, my reaction is, I'll take the 45-day lease.
The month and a half of free?
I'll take the month and a half. Nobody's offering me that though. But yeah, some really scary numbers there. And Martha, you asked before, what are we going to look at? I think there's two parts to multifamily. One is that this will be a much slower to play out issue. So what we're looking for is signs of cracks probably in August and September, right? Are we seeing really sizable dips in debt service coverage ratio at that point? And then also, we should see the same type of behavior mall owners were doing for the last 10 years, which is it's an option, hold on to it. I'm not putting a lot of money in my pocket. This thing is covering its nut. Why not hold on? But if things get so bad that you're starting to see, 60 and 70% occupancy levels, then you're looking for, is there an uptick in default levels and so forth. But I think that that's something, we revisit back, in October, something like that, but something to watch longer term.
Yeah, I think the forbearance numbers out of Fannie and Freddie are still pretty low.
Yeah.
Don't quote me, but it's still around the 2% of the whole universe area. We assume that will continue to increase, but we haven't seen a huge uptick like we've seen in the other property types. We do have an issue though of maturities right? So these multifamily loans that are interest only, that are 1.2, 1.3 debt service coverage ratios, if they come to renew and they're looking to refi with Fannie or Freddie, the epic levels of reserve requirements and DSCR and LTV thresholds that have been put in place may make it untenable for them to get that same level of refi, right? So they could probably go to a bank or some other, non-bank lender and get slightly more onerous terms, higher rate, maybe lower proceeds or something like that. So there's going to be a distressed play here, even if the fundamental distress is not, very large, even if it's just, a slight blip to multifamily, the crimping of the credit nozzle is going to hurt.
It'll be interesting to see if they can hold that line. They do answer to an awful lot of homeowners around the country, and those homeowners are voters, and those voters are looking at an election in a couple months, I should say. So whether they can hold that line or whether there'll be political pressure to become more accommodative, we'll see. My gut tells me that if this becomes a problem over the summer, that a loosening of the reins may be something we see.
It's the Fed put and the Fannie put and the Freddie put. It's the government backstop.
Right.
Trepp also continued its spotlight on CMBX this week with a write-up on CMBX 7. And like CMBX 6, it has a high concentration of retail. But why is this index worth watching?
Well, we're doing one each week. And like you said, Martha, we started last week and now we're on to CMBX 7. We're going to try to pick out something each week that is unique to each index as the reason for looking at it. What was unique to CMBX 7 is it has the highest combined aggregate number of retail plus hotel plus multifamily. We've talked for a long time about the Big Short CMBX 6 BBB minus because you have about 40% retail and about 20% mall debt. But the cost of protection before Thursday's debacle, and I haven't seen Thursday's numbers yet, but the cost of protection was about 1,600 basis points for CMBX 6, which is an awfully sizable carrying cost if you still think that short has some juice in it. The CMBX 7 doesn't have as much mall debt and has slightly less retail debt overall, but its carrying cost is hundreds of basis points less. I think it's under 900 basis points before Thursday's sell-off. And in addition, you get more hotel for CMBX 7 than you had for CMBX 6. So for those that think that CMBX 6 has gotten too played out for the short, our thesis was that CMBX 7 has a lot of the same attributes, and in the cases of hotels, more. So something to look at on our blog this week.
And if you feel that multifamily is the next hard hit class, this will be an index I think people will be interested in.
Yeah, the multifamily that's in, maybe I'm going against everything I ever say outside of the podcast, but the multifamily that's in conduit CMBS tends to be, slightly higher risk. Student housing, senior housing, the very, very large loans or the medium-sized loans that couldn't qualify for Fannie or Freddie financing, or that the borrowers chose to go with CMBS straight up conduit because they could get slightly higher proceeds. So all of that is to say that, the multifamily that happens to be in these conduit deals was likely slightly higher risk already before the pandemic.
Turning to corporate CLOs this week, I saw the Wall Street Journal had an article that pointed out that the biggest risk in the moment is a supply of credit, not losses. Explain that for us.
Yeah, so I read this article, and we've been talking about corporate CLOs for a while, especially in terms of the specific term loan and corporate exposures. And, there's been a lot of talk about what the losses could be, what the default rates would be, and so on and so on. And I think the moral of this particular story was that at the AAA level, the worry should not necessarily be about losses, because there is enough credit protection, credit enhancements, principal diversion rules and other things that protect the AAAs. The worry was that if there are enough downgrades to the collateral in these deals, enough to actually downgrade the bonds, a triple B minus turns into a double B, a double A turns into a single A, and so on, that the actual kind of demand for CLO paper in general on the buy side could potentially diminish. And if that happens, it's kind of the supply of capital diminishes, and therefore the borrowers that need to refinance don't have as much capital to tap. So it's kind of this virtuous or vicious cycle, depending on what's going on. If enough of these kind of investment grade buyers see the market as too risky, or are literally like insurance companies, most of them can only buy investment grade securities. So if they're no longer investment grade and they're forced to sell, like that could be a capital crunch.
And I would say about the leveraged loan market, it's a market that trades on confidence, if you will. When things are going swimmingly, credit is cheap and available and plentiful. And I think that, the COVID open trade was in full bloom for the last 45 days. We saw huge run-ups in the stock prices for airlines and cruise operators and others. And I think some of that trickled down into confidence for some of these hard hit credits that these guys will be able to muddle through. There's always whispers of bankruptcy for, whole categories of the leveraged loan market, but it seemed like that chatter had diminished as confidence grew. And on Thursday, we had the 6-point sell-off in the stock market. So, and among those, we saw some 20% losses in airlines and cruise ships and so forth. So confidence in that market can be very fleeting, and it was in very short supply today for sure.
Well, with Father's Day over a week away, I thought I should ask, what is on your wish list? Because I really do need some ideas.
Well, Martha, to be completely honest, why not surprise the big guy with a subscription to the Trepp Podcast? Nothing says thanks, Dad, like the podcast. It's affordable and, dare I say, essential, just like soap and toilet paper and food in these days of these tough times. And I don't know what kind of budget we have these days, but maybe we could do something special. Can we do something with like an 8x10 glossy of Joe or Keegan for the first 200 guys that tweet at us? We send it to them, as part of the Father's Day package. Something suitable for framing that would look great over the fireplace, or
you get a bar of soap,
maybe on the night table,
a roll of toilet paper, a signed picture that you have to put on up above your toilet, right?
No, the night table
goes in the bathroom.
The night table.
Our loyal listener Dave will be the first one to sign up.
Why don't we get glossies of Dave?
That
8x10 glossies of Dave. Do we have the rights to redistribute his image?
Our very special listeners.
I think he signed a release when he retired.
For me, my wife and her family are big gift people. They give a ton of gifts, and I'm not really a big gift guy. I don't need much. So I always say, if you buy me a box of golf balls, that's pretty much all I need. But what I'm really hoping for is on Sunday. By the way, I'm sure a lot of you have been watching, because everyone is as into golf as I am. The first PGA Tour event is happening as we speak, live with no fans. Here's my Father's Day gift. Ready? Give me a full night's sleep and let me sit on the couch for 5 hours and watch golf. Now, I know that's too much to ask, so I will settle for a box of Pro V1s.
We'll get you one of those 8x10 glossies.
And with that, we'll close. Thanks to our producer, Keegan St. Ange. Join us next week. We have a special podcast on the borrower experience And then join us at the end of the week where we talk about what's happened and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com or look for our poll for topics. Until then, visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.